We expect to see build for rent deceleration. It just isn't penciling. We're seeing build for rent developers that are trying to sell a lot of their communities to builders for the for sale market because the challenges with the higher cost of debt. We see that market right now under a lot of pressure.
Folks, one of the things I love about One Rental at a Time is we have attracted the best of the best in the housing industry. The gold star of that, of course, is Lance Lambert from Resi Club, ResiClubAnalytics.com. Go get your free daily newsletter 5 days a week. Lance, how you doing, man?
Doing good. Thank you, Zuber, for having me on. Housing, housing, housing. And there is just always so much going on. And this week, I'd love to talk about the housing market's big deficit. And yes, there is a huge deficit in the housing market. And it's the fact that there's the fewest number of new listings pretty much ever on a population adjusted basis. There is just very little going on to the market. And the reason being is the mortgage rate shock. You have so many people that have a 2-3% mortgage rate, very low monthly payments, and they have very little incentive to sell their house to go buy something new because one, it would be a huge financial shock to them. And two, a lot of them couldn't even qualify to do it if they wanted to. So a lot of people are staying put with their lower fixed debt monthly payments. And what it's translated to, and I'll share my screen to show my calculation, is I tried to actually put a number to it to find out what's the actual listing deficit in the United States. And so how I did the calculation is I compared every month over the past 3 years to the same month in 2019. So
I like it.
2019 is normal. It's a normal year. It's a normal number of listings, normal appreciation. The housing market was just very average in 2019, historically speaking. And so if a month over the past 3 years had fewer listings than 2019, I call it a deficit. If a month has more listings than 2019, I call it a surplus. And please keep in mind, these are new listings, not active listings. So if a market cools way down like Austin, Texas, active listings can climb even if new listings aren't. And actually, Austin's down for new, but then up a lot for active. So keep in mind, this is just what's coming onto the market. And what we see is that we had in November, and I got the December data today. I got to take a look, but it's around this number still. We had a 52,000 home deficit in November. And so here you can see it. The blue is the number of new listings, and this orangish red is what's missing from the housing market. And what occurred is back in January 2022, we went into a deficit for the number of homes coming onto the market. As mortgage rates went up, got a deficit. And we are starting to see on a year-over-year basis, the deficit's not as big. The peak of the deficit was like, in terms of like year over year, November of last year, there was a 74,000 home deficit. Now, in the peak of the spring buying season this year, there was a 200,000 home deficit in like June or May. Like you can see it right here in this chart, like it gets really high. So it getting smaller here, that's seasonality. And you really have to compare as year over year. So you got to compare this November, and it's not labeled well enough, but it's to this November. And this one is just a little bigger. This deficit will get bigger again this spring. But the question is, does it get as big as this? I don't know, because now we are seeing that on a year-over-year basis, new listings are up just a tad. So maybe like peak lock-in effect is behind us. But what we do not have is momentum to close the deficit. There is no momentum to close this deficit. Things would have to dramatically change. And the way that I look at this, if you want to read this, how I kind of think of it in my head, is here, this big drop in the new listings, this was the lockdowns.
Correct.
So we are on par with the new listing deficit this year of what the lockdowns were for just 2 months. And the lockdowns, they shut the economy down.
Yeah,
So
yeah. There were realtors that couldn't show homes, Lance. I mean, that's crazy.
exactly. And so that's why I kind of like this being there, is that is a
Yeah.
dramatic drop down, historically speaking.
Mm.
And then we're now in this for like a year and a half. Like we've been in this 18 months and just not a lot of resale supply coming on the market. And what gets this moving up? Well, it has to be, you would assume, an improvement in affordability. You would need mortgage rates to come in and maybe significantly to really get new listings back. But you have people like Sean Amherst, who's the CEO, or Sean Dobson, the CEO of Amherst. They had 44,000 homes, and they have the best turnover model, which is modeling down to like an individual home level, the odds of somebody selling that home within X number of years. And private institutions all over the world come to them to buy this model and to use it. And their model actually has new listings falling further. They think turnover is going to get worse. And this lock in effect of these people with 2 and 3% mortgage rates, which Sean told me is he thinks those homes were essentially burnt down, is how they're thinking of it. Like they're just not selling a lot
Yeah.
unless they really have to.
Yeah, this is I mean, you and I talked well over a year ago that I called it the Fed broke housing. And what does that really mean? They've killed turnover for decades. Turnover, aka the move up buyer, was a process you could almost calculate. And it sounds like Amherst has. That is all those models are broken. They're just broken.
Well, yeah, everything's pushing out further. And we had already, for demographic reasons and other reasons and state regulation reasons and stuff like that, we had gotten to a point where turnover was already moving to the new historic
Correct.
highs and continuing to set them. And now you have the demographic part of it where people live longer, have been migrating less.
Mhm.
Um, and then you throw in the fact, oh, and now those who have mortgages, a lot of them have 2 and 3% mortgage rates. I mean, the net effective is 3% mortgage rate. At 3.6, that was measured in the summer. Maybe it's up to 3.8 now, but still, it's under 4%.
Yeah, the
Um,
effective mortgage rate at 3.6 now, call it 3.8. You're absolutely right. That's yeah. There's no financial incentive. You're only going to move if you have to. Frankly, I'm actually hearing more and more people, Lance, turn their house into a rental and rent somewhere else, right? Which is not something you typically do. Once you become a homeowner, typically speaking, if you have to get a job somewhere else, you sell the house, move the equity to your new location. But to your earlier point, people don't qualify. You might
yeah.
be a homeowner already, but you can't qualify under the new price slash rate area. It's the market's broken. It's just broken.
Yeah, it's a very constrained market is the way I would describe that. And that's putting it very nicely and kind of
That's the Lance politically correct answer. The market's broken is Zuber's answer. I want to switch gears because one of the ways out of this mess is build for rent, right? We obviously have home builders building homes for owner occupied, but there's also the build for rent model. There's a lot of talk, a lot of doomers out there chasing build for rent, saying it's a model that's broken. There's all this hidden inventory. It's doomed to fail. But you actually talk to the CEOs. You're not just some poser on the street. You actually talk to the CEOs. So what's going on in the build for rent area?
Yeah. Yeah. So I had a conversation recently with the CEO of I think it's Lotura Development. I don't know how to pronounce it. I'm not the best at pronunciation. But he is a developer out in California. They're actually one of the biggest in the Southwest
Hmm.
for apartments and I actually no, it's multifamily residential that they're big in, and then self-storage. They're like
Got
one
it.
of the biggest in the Southwest
Hmm.
US. And they decided to do a build for rent project. And what it is, their CEO, Charles, he was out in Albuquerque looking at an apartment building to buy.
Hmm.
And the agent there told him, hey, and so the numbers didn't make sense. He didn't want to get the building, but the person showing him the building, the agent said, hey, if you had a build for rent community, I could lease it faster than you could build it. And she said, for evidence, look at this place. It's packed full of millennials, and they're starting to have families. They want more space. We don't have enough single family rentals here, and townhomes. And so he decided that was a good idea. And the past couple of years, he's gotten everything figured out. And they are now building. They've gotten into build for rent, and they're going to do it in Albuquerque, like 300. It's 340 units total. 142 are single family homes. 202 are townhomes. And they have, there's community offerings like co-working spaces, barbecue areas, pools, fitness, and stuff. But it's really geared at those millennial families who are now moving from their multifamily renting. And if they can't afford to buy a home, or they're not ready yet, they kind of want that single family or townhome rental. And so he's preparing for that. But he's doing no financing. The rates just don't make sense. He's not doing financing. And what he said is, if they can get rates down a bit more, maybe we come down another point, then before the deal all closes, they'll do financing. But right now they're waiting on that part. But he said the biggest thing that's going on in build for rent right now is just the math doesn't make a lot of sense because of the capital cost. And so what he believes will happen is that there's going to be a very big pullback, or a pullback in build for rent completions.
Agreed.
Not now. Now it's fairly high because they're still coming into the market. But he's thinking by the time this community's done, which they just broke ground last month, they're going to be done late 2025 into 2026. He's hoping by then things will slow down because there's not a lot of new stuff getting started right now.
Yeah,
like
there's
in
not a lot of groundbreaking.
Yes. And a lot of the stuff that's going onto the market now or about to go on the market, this was stuff that was financed during the pandemic, which gets you into a whole discussion about the economy, which gets me wondering, like, is the effects of this rate hiking cycle still pushed out further? Because there's going to be a big drop off in multifamily. Not this year. Right now, actually, the number of completions this year are going up. There's going to be a lot of multifamily units hit the market this year, but after, that's when you might start. Yeah. But so what Ivy Zellman, I listened to a podcast she had 4 weeks ago. She said a lot of these build for rent starts, which, starts right now, like they're starting the projects to build, were purchased and financed a year or two ago. We expect to see build for rent deceleration. It just isn't penciling. We're seeing build for rent developers that are trying to sell a lot of their communities to builders for the for sale market because the challenges with the higher cost of debt. We see that market right now under a lot of pressure.
Yep.
So, a lot of these firms that wanted, have these communities of rentals, they will partner with the builder to build them.
Yep.
And now, based on what Ivy's saying, some of them are going back to the builder and saying, hey, we'll sell it back to you and you go sell for the purchase market.
Yeah.
So that's kind of interesting. But she added, don't expect it to go away, which it sounds about right. Because, the view a lot of these people is that even if you don't believe the U.S. is underbuilt in terms of the multi side, a lot of people believe the single family side is underbuilt. And so there's still a demand out there in the marketplace for these single family rentals. For your crowd, it's probably a good thing to see a deceleration in the number of completions for single family rentals.
Absolutely.
And it is worth noting that single family rents in almost every market in the US were up last year. And the couple that were down, we're talking like Austin, and it wasn't even down a full percent for single family rents. And house prices in Austin are down like 15, 18%, which is interesting. But then on the multifamily side, especially in the boom towns, we are seeing falling rents, lots of incentives, and more downward pressure this year, potentially, as all these multifamily units hit the market. So I think the story with real estate is always know your categories, and then also know your submarkets. And then within, like you say, know your buy box as well. There's always a lot going on that it is a lot more complicated than just the headlines.
Yeah, I think there's so much in that I just want to hit again. One, you did an article, Resi Club Analytics, I think it was 2 weeks ago, talking about single family rents. And again, up in all markets, a couple of that were down, were less than 1%. I think that would surprise people because the narrative is rents are falling. Multifamily, certainly big multifamily versus singles, is a very different market. And no one really focused there except you in Resi Club. The other thing is, you and I talked about 9 months ago, it might have been 10 months ago, that given Silicon Valley Bank, First Republic Bank, community banks, commercial banks pulling back, builders were going to suffer. And this is what we just talked about with build for rent is one example. It doesn't pencil. Pencils down. We're not doing the deal. That is going to come back to bite us this year sometime. And we talked 9 months ago, it's probably the spring. There's going to be less net new inventory from builders because they sat on their hands. So I am nervous about what we talked about very early on is, the deficit. I think it's going to get worse. I'm not sure we've seen the peak, especially if rates stay, 6-ish. I don't know where you come out on this. There's been plenty of opinions and articles about the magic interest rate where supply is, the move up buyer comes back.
Yeah,
I don't,
I think I'm hopeful on single family construction because
okay.
the purchase market, the builders went out and they met the market. They found out what was the right mix of incentives and affordability adjustments. And this cycle, it was buy downs. They found out what worked, and they've been able to keep it going. But yeah, it'll be interesting to kind of see how it plays out. Affordability is obviously a stress. And there are some builders in some markets that are feeling more of a pinch. And like you said, there is the fact that one, there's a tightening of lending after the bank crisis. And then two, not everything's as rosy for the small builders. They don't have in-house mortgage companies like Pulte Group, like Lennar, like DR Horton. And so they've kind of been slower to catch up with their affordability adjustments. And then the third is this whole build for rent thing. And that's probably further out, the pullback there, in terms of the institutional capital flowing into these build for rent deals that's really pulled back since rates went up a lot.
Mhm.
But it'll be interesting to see how it all plays out. The thing that I do think will happen is there will be as we get past 2024, the multifamily side, what's coming onto the market is going to come way back. And there's that will pull pull back. And the reason that multi rents have softened more is because there was just a ginormous amount of supply coming into the market that the single family side just didn't see. And one thing is there has been a bit of a pullback in like housing starts, but the amount of completions for single family homes has stayed fairly strong despite the pullback in starts. It hasn't been felt on completions. And the reason is the build cycle was able to be reduced by 2 months almost
Mm,
as the supply chain issues got worked out.
makes
And
sense.
so the completions actually stayed steady despite the starts coming down, and
That
despite
makes sense.
permits coming down. But we'll see how it plays out long term. But yeah, I'm hopeful that the housing starts side stays resilient. Just
Yeah.
because if you look at the sales, which is the very beginning of the funnel, the
Mhm.
builders have done a good job in terms of moving sales back up over the past 12 months.
Yeah. I don't know if one of your mini data sources in your network includes a company. I think it's called TREP. Uh, based.
I don't work with them directly, but they are one of the best, especially for commercial real estate.
Yeah. So the reason I was bringing this up, one of the people I speak with on Thursday is big in the multifamily syndication space. And apparently on LinkedIn, Prep published an article recently, like this week, that multifamily pain is larger than office pain, meaning delinquencies, foreclosures. And not part of that's because multifamily is bigger than office, but also because multifamily was the land of new syndicators and overpaying, where office was always kind of the insurance companies, all of that. So I think the pain in multifamily is it's just starting.
Well, so the reason we don't hear enough about it is one, the people who publish a lot of the very negative content, that side of the world, that side of the economy just goes over their head. It's too
Yeah,
complex.
it's too
It's too much.
complex.
Yeah. And also you know, these real estate cycles play out so slow.
Yes,
The story can be
exactly.
boring. And then yeah, so it will be interesting to see how that all plays out. You know, have a close eye on. And you know, even myself, you know, I kind of wish I was more well versed in some of the ins and outs of the multi side. You know, there's going to be a need for really good coverage on that side
Yeah.
the next 24 months.
Exactly right. It's the next 24 months. There will be tremendous opportunity in that space, but to your point, it won't be an event, it won't be a cliff. It'll just bleed for 24 months. Yes.
Yeah, and you know, and there will be some big groups that go down probably. I mean, there's
I will say absolutely. There's plenty of pain coming.
yeah.
And of course, where there's great pain, there's great opportunity. I believe, and I've said publicly, that the opportunity this cycle is in multifamily. And the good news for folks like me is it's not only the big boys, it's the 5s to 40 units.
You
The
know, I
same
do want to
stupidity
actually
happening.
say one thing is
Uh-huh.
there will be small pockets of
Mhm.
single family distress,
Sure.
not because of the single family markets necessarily, but because of the debt financing within some of these groups, and they accumulated so fast.
Exactly.
So if you
Exactly.
read Resi Club, I actually found one of these working with Parcel Labs. It's called Vinebrook.
Mm.
They own 27,000 homes. Now it's down to 25, and they have several hundred on the market right now. And I looked in their late November SEC filing, and they have like $100 million loan coming up, or 150. I didn't look
Ooh,
at it
yeah.
again, but it's a big number. And they
Yeah.
said in there, we'll probably have to continue liquidating homes to cover it.
It's about the
And
debt.
so
It's always the debt that blows people up.
So there are like 20 or so of these neighborhoods where these home zip codes where the Vinebrook homes now make up like 20 or 30% of the inventory. They are
Wow.
taking price cuts.
Oh, no
Uh,
question.
Look at the Dayton, Pittsburgh, Milwaukee, Cincinnati. So I do think there are potentially some opportunities in single family homes, but you have to really have your ear down to the pavement or whatever that saying is to
Yeah.
find some of them
Just
because
do the
they
work,
are going to
folks. Do the work.
yeah, they just aren't going to be like the multi-side,
Yeah.
where you know there's going to be a lot more of those. Although
Yeah.
the problem with those is it's a trickier world.
Yeah. It's gonna be pretty awesome. Well, let's not forget, Lance, you in Resi Club is coming to our event in Vegas, February 17th and 18th. It's like 45 days away or something. I know a lot of people are going to look forward to seeing there. They're going to want to be taking your picture and asking you questions. So thank you for coming out. I look forward to seeing you in person. Where can people find Resi Club and get these free articles Monday through Friday?
Yeah, you can find Resi Club at resiclubanalytics.com. That's the website. I do one free issue during the weekday every day, so 5 issues a week. And then I have 3 additional stories to go to Resi Club Pro. That's my premium tier. Give access to a lot more of my spreadsheets where I track inventory days on market prices, county level, metro level, about to do zip code, but not quite ready. And then you can also find me on Twitter at NewsLambert, where I'm constantly every day just tweeting out a lot of housing stuff. Right now, I'm on a little bit of a home insurance kick because there's
Ah,
just a
yes.
pretty big shock there, which would be an interesting topic to get into as well.
Uh,
But so at News Lambert and then resiclubanalytics.com.
yeah. I have some direct experience with some significant increases in insurance this year. So yeah, we can talk about that. Maybe we'll make that a topic for next week. Lance, you're amazing. Thank you for saying yes to come out to Vegas. I know the audience will love to see you there. Take care.
Thank you.